So I think it's very imperative that we talk about this recent phenomenon that is happening in the markets, where ever since this banking crisis really started to develop, and SVB and Signature and these crypto exchanges and a lot of other smaller players were all of a sudden going bankrupt in the banking industry, there has been a real rush to safety within the large tech stocks. And let me just read you guys this headline, because I think it'll make sense in regards to the title of this video, how essentially margin calls and forced loan recalls could come based off of tech stocks getting obliterated. And we'll get into exactly why that is and what's likely to happen here very soon. So the headline says tech stocks are now among the most overvalued after investors flocked to the sector for safety during the banking crisis. And this is coming from Barclays. So we're going to get into this situation. We're going to look at AMC, what's happening here on the day as well, and what the numbers do look like with this certain stock. And I think this pertains directly to stocks that are very risky in the markets, right? When tech gets destroyed and it's seen as the safe haven, it can help benefit those risky stocks that are prone to short squeezes, prone to losing investors a lot of money that are short on these names. So we'll elaborate on this more throughout this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. I know you got some comments, questions, or concerns, so let me hear them down below in the comment section. Also, if you guys want to come trade with me live in real time as well, link down below in the description of this video. Great place to be, great community, and could definitely help you enhance your trading skills. So let's get into what they have to say. First things first. So it says the banking crisis that erupted this month ignited a rush into large cap tech stocks, and the flight to safety has left the sector among the most overvalued in the market, Barclays said in a note Monday. Quote, flight to safety has benefited tech thanks to lower yields and the sector's quality bias. We caution against chasing this trade, however, considering elevated valuations and extingent inflation/rate risk. Venu Krishna, head of U.S. equities strategy at Barclays, wrote to clients in a note published Monday. A slide in treasury yields from last year's peaks has helped fuel the 17% jump in the S&P 500 information tech group. The slump in yields can translate into lower borrowing costs as high costs cut into the value of future earnings for tech and other growth companies. The S&P 500 turned negative, but has since risen by 4%. And it goes on to say that, quote, tech is more intertwined with the real economy than ever in a post-pandemic world. And our premium long-duration equities really an appropriate safe haven as we deal with both rising interest rates and tightening credit. We don't think so, Krishna wrote. Quote, rather than chasing yet another crowded trade that is vulnerable to the next unwind, we recommend seeking safe haven among quality stocks at less demanding valuations, he says. Barclays said the banking crisis pushed it closer to its view that a shallow recession will take hold of the U.S. economy sometime this year. In that scenario, it sees the S&P 500 ending at $372 or 37.25, which would be the actual S&P 500 price. The ETF would trade around 372, which represents a 6.1% decline from Friday's close at 397. Investors have flocked to mega cap tech stocks as they generally screen well on quality metrics because of their strong balance sheets, high profitability, and earnings stability. However, quote, we think the rotation was amplified by crowded trades getting caught offsides and squeezed out of their positions. Including the severe underweighting of tech heading into the banking crisis, the investment bank said. So I think this is pretty interesting. Now, if you connect the dots here, there's been a lot of rule changes within AMC over the last, couple weeks, couple months, couple years, and we've documented them when they happened, right? And there's not as many changes that have been happening as of recently, but what we have seen over the past year are rule changes, like placing high collateral on these short positions for AMC. These banks, they're not allowed to essentially take in low quality collateral for these high risk trades. So a lot of Apple, right? Specifically Apple, Tesla, Microsoft, Google, Amazon. These are the kind of companies that are pegged to a lot of the collateral that is in hedge funds portfolios set aside for these AMC positions. It's a fact. You had to be what, AAA rated? I think only Apple and Microsoft are AAA rated corporate debt, essentially collateral, that could be used on AMC. Now, treasury bonds would also be something else. A lot of hedge funds don't necessarily buy treasury bonds, or at least a lot of the hedge funds that are trading AMC and going short on AMC typically don't have a lot of other high quality, collateral besides Apple, Microsoft. I think Tesla is pretty well rated now as well. As of the last, I believe, 2 weeks ago, they got upgraded to investment grade, but still they're not AAA. So there's only a few names really that is probably backing a lot of this collateral. If these names start to get some pretty big haircuts here, well, it's going to put a lot of pressure on the collateral that is posted for these AMC short positions. And I do think that is something that can help get you to a squeeze, especially if you get the right combination of news. Possibly it's around this April 27th court litigation. It can put a lot of pressure on these shorts that are short on AMC, especially as we head into earnings season. Earnings season will be big for these technology companies. So and ultimately, if shorts cover on their short positions, or if the banks just demand their collateral back because or their money back really for these loans, because when it comes down to it, if Apple were to fall 50%, the collateral's not seen the same way, right? So hedge funds would either have to put more collateral up or just cut their losses at that point. And I ultimately think that is what is coming. And it looks like Barclays and some other investment banks are starting to see the same concerns, that tech has got way overstretched way too quickly here. And I think that has big implications for a lot of your riskier trades in the market, specifically around AMC, GME. And that's really it. Those are the ones that I would personally play in regards to this. But, it could go for other companies as well. Keep that in mind. Now, as far as what is happening here on the day with AMC, if we take a look at the charts, we're like intraday on the day so far right now. Facebook Meta is down 1.5%. Apple is down 1.15%. Pretty rough day overall for these technology stocks. Now, a 1% drop on Apple isn't going to change too much, but if you start to string together some pretty bad days, Apple, after all, is really not seeing the same level of bullishness as you would have expected. Apple is actually underperforming the overall tech industry. And it could get a little bit worse from here, especially as we do get into earnings and analysts start to revise price targets. They start to revise their earnings estimates. That's what ultimately guides stocks higher or lower, is earnings upgrades, right? Or company upgrades from analysts, and price target upgrades. Earnings estimates going higher ultimately decides how stocks trade when it comes down to it. That's what algorithms are mostly based off of. So not a great day for those large tech stocks. And look at AMC. It's only down 1.34% right now. That is very strong. I mean, Meta, Facebook, is down more than AMC. I think that is telling you a lot in and of itself, and I think that's important to note. Now, AMC still struggling around $4.50 per share, and I think that is important to also point out that we have a major resistance level at $4.50. We need to get above. I don't know if it's going to happen today, if it's going to be in after hours, if it's going to be tomorrow, but I know eventually it will happen, and when that does happen, I would expect to see a breakout from there. If it comes with news, you could see a pretty big day overall for AMC. Now, if we take a look at the Ortex numbers, Take a look at the live short interest of free float sitting at about 25%. And you also have 129 million shares that are currently sold short. Cost to borrow average of 385%, cost to borrow max 398%, and cost to borrow minimum at 328.35%. Interactive Brokers has 214% cost to borrow rates and 0 shares that are currently available to be lent out. And I do think these cost borrow rates again are reflecting extreme volatility that is still likely in AMC stock, and it wouldn't surprise me if these cost borrow rates were going higher because of some of the collateral that is presumably about to get whacked, like your Apples, like your Microsoft, like your large tech names, as you do likely see a rotation out of those companies into more staple kind of names throughout 2022. The safety trade, the flight to safety, it was never about large cap tech. To some degree, Microsoft and Apple did do better than the markets, but everything still got destroyed besides your healthcare, besides your oil companies, right? And specific pharmaceutical companies. That was the flight to safety. And I do think that could ultimately come back as people start to understand that a recession is coming. Usually in recessions, oil, that usually doesn't work. But in your butter and toilet paper kind of companies, those are usually the ones that do the best, at least when the recession first starts. And around this time period where you're not in a recession yet, but you know one is coming, that's typically when those kind of stocks like to outperform. Now, what's also interesting here on the day is the markets are starting to price in a stronger probability of getting a 25 basis point rate hike coming May 3rd. So that's probably also part of this. You are seeing the 2-year bonds, some of the shorter duration bonds, that their yields are going higher today, and that is good for this yield curve inversion that was starting to uninvert at a very rapid pace. It's starting to invert yet again, which is a good thing. It's showing less economic pain potentially to come. Higher interest rates in the short term. The only way interest rates go higher is if you don't go into a deep recession. So this is like the push and pull tug of war between, are we more fearful about rates going higher and the cost of capital, getting higher and the bank crisis, or are we more concerned about the pending recession? Well, today it looks like a good bit of both, I would say, but rates are going higher, meaning people are a little bit more fearful today about the Fed actually raising rates, not the imminent recession. And the probability of a 25 basis point rate hike May 3rd sits at 44.8%. 55.2% chance of getting a pause May 3rd. These probabilities have actually went up quite a bit. Friday, you only had a 16.8% chance of a 25 basis point rate hike. Now you're at almost 45%. So that's a big jump, and you definitely want to watch this over the next couple of days, and especially as we start to get more economic data like we went over in the last video. Specifically on Friday, core PCE index, month over month and year over year, those are going to be huge, as well as personal income and personal spending month over month, which also comes out on Friday at about 8:30 in the morning, guys. So that is going to do it for this video. That is what you need to know in regards to all of this. Long story short, I do think this can be a very bullish thing for specifically AMC if the collateral starts to get whacked. Simple here, right? Hedge funds, they're going to have to put up more collateral, or they're going to have to cover on their short positions. Which one makes more sense? Well, AMC sitting at the lows makes a little bit more sense to actually cover on your short position than to put more collateral up and then more collateral and more collateral, right? So you can start to see, hopefully, how this is pretty clean cut, straightforward information, especially if you've been watching this channel for a long time now. Then you know you can't just use any old stock for collateral in AMC. It has to be AAA rated. Not too many stocks and equities and just overall securities are AAA rated and worthy of backing some of these AMC short positions because AMC is so volatile, and that's the main key to it all. Banks don't want low-grade collateral when you could lose billions of dollars by lending to these hedge funds. So leave your comments, questions, or concerns down below in the comment section on all of this information that we covered here in this video. Like the video, hit that subscribe button if you have not already, and make sure to check out the link down below in the description of this video to join the trading community if you guys would like to be a part of it. Thank you for watching, and I will see you in the next one.